Welcome to another call update. Last one was March 20th. We'd like to do these every 2 or 3 months, and here we are a couple of weeks later. Reminds me of Donald Trump 1.0. This is, markets. I'm not going to give you the exact year-to-dates and everything because we're in a state of flux right now. We started the year by saying that the U.S. stock market was overpriced, probably by the tune of about 20%. Europe was undervalued. There were pockets of sectors we like. We're going to dive into that. U.S. market has now intraday a couple of times punched to a 20%, what they call a correction or a bear market. 10% is a correction, 20% is a bear market. And, this is in the face of we actually had a call saying if Trump wins, the market's going to go up. And then we said the problems with the market will start around Inauguration Day. Well, I was wrong because they started about 2 weeks later. And it's been far lower than when Trump got inaugurated. So let's dive into it. So this is yesterday. And what's happening with the stock market? We went from a period where the United States was the consensus was exceptionalism. So this is a market that, where people were talking about being, no recession in sight, pro-business, what a place to be, you're only going to make money, to this is yesterday, a survey of executives summary. Do you expect the U.S. economy to experience a recession as a result of the newly announced tariffs? Over 50% said, yes, there'll be a recession. And then there was another just under 20% saying, well, the recession would start in 2026. And about 15% said no recession. So we have the majority of people from going exceptionalism with no recession in sight to a possible recession. So let's dive into the numbers and just go through what the playbook is, okay? Because we look at a playbook and then we're going to go a little deeper underneath the surface of a playbook. Number one, and I don't expect this to be a long call, but I'll get everything as quickly as I can. If you did nothing in your life, these kind of panicky sell-offs are rare. They don't happen on a yearly basis. Most years we do have a 10% correction, 20% corrections. Of course, during COVID, without COVID, it was 2018 under Donald Trump. So they do happen. The playbook is 1 year later, if you did nothing but step into the market the day that it's down 20%, the 1 year return is 29. So we've got that going for us. Now that's superficial. We'll dig a little deeper. I also want to tell you that if we do go into recession, the average drawdown, the average decline of the S&P 500 from no recession to the bottom of the stock market as you enter a recession, and by the way, the stock market tends to bottom as you enter a recession, is minus 23. So at minus 20, we're not that far off of pricing in a recession. Again, we started with U.S. we're overvalued. So I'm going to go down here and talk about what the title of this call was, Flashing a Problem. And that is that, as we have stated before, this is the most important economic indicator. It's called the yield curve. And this is a picture of interest rates in the United States, the actual rate and the term. Because interest rates you could park your money into a 90-day T-bill and you would get about 4.3%. And these are today, we have to update them because rates are up today. 2-year bonds just under 3.8, a 5-year. Now you can see the conventional wisdom is a yield curve is the spread between the 2 and the 10, and that's still a very healthy curve. But when you are that steeply sloped between a T-bill and a 2-year, the market is screaming at you that maybe you don't have an 09 style crisis, but the market is telling you that the Federal Reserve needs to cut interest rates because there's a problem with the economy. And it looks like a short-term mildish recession is what's being priced in. Again, we can debate how severe it will be, but this is what the now let's remember, interest rates are set by the bond market. The bond market is live, and it prices in every piece of economic data within seconds of any data releases. So these are live, and even Trump tweets and things like that can get priced into the bond market right away. Now, I'm going to go back 1 second on the yield curve. Since 1950, there's been 13 recessions. Okay. That means that 1 out of 6 years we have a recession. Okay. Recession was COVID 2000. It's highly possible just on the duration length of time. It's certainly within the realm of possibilities. So since 1950, 13 recessions. Every single one of those recessions was preceded by this inverted yield curve. But 4 inverted yield curves did not lead to recession. So again, yield curves have preceded every recession. 4 false readings where you didn't get a curve. Now, we were fortunate in 2022 that we said that it was consensus. The stock market had fallen 22%, the S&P 500, the average drawdown for a recession. We said, doesn't look like it because we're missing a key ingredient. And that key ingredient was West Texas crude oil. And oil in 2022 hadn't spiked. And it's the double whammy. When you invert the curve, yield curve, the credit available at banks begins to tighten because the cost of capital at the banks is at the short end and the ability to lend is at that mid belly of the curve a few years out. So they're making less money by lending and they tighten their credit. When you get that with the double whammy of people forking over more money to fill up their cars and drive to work, that's the formula for recession. So the good news is there's a chart of West oil, it's collapsed. The conspiracy theorists in us might question that the day after the Trump tariffs are announced and everyone says, oh, inflation, that Saudi Arabia comes out and says, we're going to increase production and we'll help bring down U.S. inflation. So I'll let you guys figure out if there was a phone call or what's going on with Saudi Arabia that they decided at $66 oil that they thought it should go down. Okay. Now, okay, so we've got the curve, but we don't have the spike in energy. Here's the problem. Houston, we have a problem. And that is Americans are scrambling. This is today's Financial Post. Americans are scrambling to stock up at Costco, Best Buy before tariffs jack up prices. This is totally anecdotal. I'm juggling some cars. I got kids at school coming back. I needed to buy some what they call tire savers. So the little hard plastic things that go under your tires and they're cup shaped so they don't create a flat spot in your tire. By accident, I'm on the Amazon.com website and I see that they are $55.95. And then I go, oh, I got to go to the Canadian website. $39 for exactly the same product by the same manufacturer, $39. I don't know what they were a few weeks ago on Amazon United States, but if you do the math, Canada has exactly the same product offered by the same company, 50% less cost. Well, interesting, 104% tariffs. I think we're starting to see you're starting to see the prices go up already. So you've got the Russia buyers. There's going to be some, as they call price gouging, because they know the prices are going to go up. And I'll talk about that in a minute, how much they think they're likely going to go. I will say that I'm going to go back here with a picture of the Costco. It's almost like there is we haven't hit the deadline. And why I say that is because the tariffs themselves are only hitting a product that was shipped after the date. So if it begins to ship, so if 3 or 4 days ago that Chinese product was put on a ship, that product is not subject to tariff. So we are really kind of looking at May 1 for the big tariff increases. Now, I think that a couple things. Number one is there's going to be some price appreciation in advance. I know the car dealerships, many of them are saying, we will not charge you any tariffs. If you're going to buy a brand new Audi, we suggest you come in. Well, do you think that the salesman's going to give you $1,500 off the price because they want to move the cars? They know, you know, that in a couple of months, those cars are going to go way up. So I think there is going to be some front running, but even the fact that cars which typically do get discounted off MSRP, you're going to see some inflation. You will also see a boost of economic activity as people try to front run the taxes that are coming. Tariffs, taxes, we've talked about that on my last call. Okay, so let's talk about the big picture here. Again, this is not trying to be emotional. We're trying to give you the facts. This is a couple of weeks ago where Rand Paul and a group of Republicans sided with the Democrats. Now, this is not going to go anywhere. The Republicans hold the House and the Senate, but we are starting to see Republicans are inherently free traders. Anyone go to YouTube, watch Ronald Reagan's address on protectionism. I mean, it's a compelling argument that is totally counter to what we're seeing out of the Republicans today. So I think at the end of the day, you're already beginning. And again, a lot of these Republicans might be afraid to speak out, but at the end of the day, you're starting to see the fractions. Elon Musk calls Navarro a moron in escalating tariff fight. These are not my words. These are Elon Musk's words. So you've got Elon Musk, an economic advisor to Donald Trump, and you've got the head of the trade negotiations, Peter Navarro, and they're already beginning. So you've got one of the chief advisors talking about the tariffs and calling him a moron. The two biggest Republican contributors, donors, Ken Griffin, Trump tariffs are a huge policy mistake. Ken Langone, co-founder of Home Depot, I believe Trump's poorly advised and his advisors are poorly advising him on the trade situations and the formula they're applying. I mean, these are just kind of putting them nicely, but again, the two biggest contributors to the Republican Party. I would say, watching Donald Trump this morning talking about, the foreigners are coming begging to do a deal. I think that is a little bit dangerous, and I think it's highly possible. And the issue is of being too negative on the markets is that if we get deals done, which I think is Trump's the art of the deal, then the market could rip higher. And if you're selling today, what are you going to do? Buy back once we have normality? I think that the danger is that you look at some United States versus China, and you say, well, China needs the United States far more than the U.S. exports to China. Therefore, they need the United States far more. I say, well, hold it 1 second. Trump is a public official. He's elected. There's midterms. He has to do a deal. Xi, on the other hand, is not elected, and I think at the end of the day could put the Chinese economy through a tremendous amount of pain to make sure that the long-term situation of trade is to their liking. So just be careful. They both need each other, and we'll see what happens. Again, I'm going to go through some stuff. So what's the playbook? This is incredible. People, this is incredible. And I've talked about the 10-year, which were about 2.25 real yield, 30-year Treasury inflation bonds. Tips: Treasury inflation protected securities. If you are nervous, if you don't want to invest, mark my words, cash is not the way to go. And why I say cash: United States has a 2.6% inflation rate. It's going to go way up. And it's going up already. Where does it settle out? 5? Do we get like COVID? 9? But it's going to go way up. There's no way that a television with a 94% tariff isn't going to go up dramatically in price. A Mercedes-Benz is going to go up. Okay, 25% tariffs. Some manufacturers lead it. Ferrari announced they are going to increase the US prices by 10. Land Rover today said, you know what, we're just going to take a few months off. No shipments to the United States. Again, so if you want a Range Rover, maybe you're going to buy something else. You're going to pay more for that. Again, very interesting. So if we get a minimum of inflation rate to 5, the Treasury inflation bonds of 5% inflation has to pay you 7.5. If there's a deal tomorrow with all the countries that Trump said, okay, well, inflation is 2.6, you're getting 5.1. This is risk-free US Treasury inflation protected securities. Economic malaise is either inflation or deflation. And what we have learned, for whether it was the 09 crisis or COVID, they have discovered something. It's called the printing press. I don't want to dwell on it because we talked about it last time. In the 1930s, they didn't have control of the printing press. When you're on the gold standard, you cannot print money. You are fixed to the price of gold. Today, we are not fixed to the price of gold. Gold has been surging. Do I like gold? Yes. Do I like Treasury inflation protected securities better? Yes. I want to point out something. Let's look at this 5-year chart of Treasury inflation protected securities. And you can see the yields on the right-hand scale over to the right. And you can see that people were buying these Treasury inflation protected securities tips at a 0 real yield. That's because in a recession, interest rates will go to just the inflation rate. That's what they're brought down to. In fact, there was periods of time in 2022 where you would have said, I will take 0.5 below inflation. That's what I want to invest in. So today at 2.5 plus inflation, if you think you're going to get in cash 2.5 plus inflation, think about this for a second. In Canada, I'll go to Canada. We have a Treasury bills are about 2.5. 5-year bonds are about 2.75. Mortgage rates are about 4.25. If we went to a 2.5 real yield, T-bills are at 5.1. Mortgage rates are about 6.5. I can tell you that that would be economic disaster. So real yields cannot go. The United States would have the same thing. You'd have mortgages at 8 or 9. So, again, if you buy this bond, my vision is, my anticipation is that real yields are going back to 0 to 1. That would put this bond, I can go through the math individually, way up in value. Like we're talking returns of 10% more for the price of the bond than you paid. Opportunity number 1. Opportunity number 2, I want to talk to you about the preferred stocks. If you're looking at your portfolio and you see a price down, one thing we've learned, if you're Enbridge preferred, the common stock value of Enbridge is $120 billion or so. The preferred stocks rank ahead of it. So they have to be paid. All of that value would have to be wiped out before the preferreds are in jeopardy. It's not going to happen. So at the end of the day, Enbridge preferred I want to show you a picture of my quote screen from yesterday. What's the price? Well, 1720 bid offered at 1808. When you see, and it's 9,700 shares. So this is in the morning, and there was basically $170,000 worth of stock where somebody's panicking and they're trading not at 18, they're saying, get me out. Okay, well, the pros are in there, and we're seeing more today because you could buy that in the 16s. Transalta D, what's the price? Well, 1485. The last trade was 1513. There's a bid at 1485, and it's offered at 1607. What's the price? You're only marking the price. In a panic, you will always trade at bids. And people say, well, look, we love TransAlta Preferred D, which resets in a year. So, look at the Enbridge Preferred dividend, 7.5. The TransAlta resets in less than a year. And if we do the math, and I'm happy to go through it, the dividend will go up about 65% from where it was because it resets every 5 years. And the last time it reset was during COVID. So it's not 473. The next 5 years are going to be unbelievable. And that is way underpriced for where the dividend is going to be. So look, there are lots we can do. Panic is not an investment strategy. Always, when there is fear out there and the markets are acting with uncertainty, because actually it's not even the tariffs, it's the uncertainty. And the tariffs themselves did nothing, or the Trump Liberation Day. We're going to have a Liberation Day. We're going to announce all the reciprocal tariffs. Well, that formula was very strange and convoluted. And it was basically the trade deficit with those countries was what they called their tariff rate. But we're going to talk about deals. So that uncertainty is out there. If you're Apple, you have 104% tariffs coming on your iPhones. US dollar iPhones are 1,000. Are they going to go to $2,000 or 1,700 US dollars? Well, that's going to hurt sales dramatically. And the upgrade cycle will probably double from 2 or 3 years of owning a phone to 5 or 6. So that would be very painful. So are you trying to punish China, or are you trying to punish the shareholders of Apple and Nike, which makes a lot of their products in China, or Vietnam, which has outlandish tariffs? If you're Apple, wait, are you doing a deal, not doing a deal? I think that there's tremendous pressure to do deals. And I would say that if you're sitting with money on the sidelines, the Treasury inflation bonds, I mean, there's so many bargains out there. We talked about the bubble in technology. Wow, have they corrected? It's kind of exciting, but we're disciplined value investors. I mean, Google is trading at 17 times its trailing earnings, which is historically lower than the value of the stock market, with excellent earnings growth and amazing potential. So you've got that. We've got US dollar preferreds from Wells Fargo that were trading at $22, trading at 17, yielding 6.25, 6.3. So I got to say that these are the times that I get excited. We're not going to abandon a good old-fashioned, good value U.S. industrial, but we are also not starry-eyed. We said the stock market was 20% overvalued. It's down 15. Europe is down 1. Why? Because it was already factored in a recession. It's hard. Now, again, I know it was up, but year to date, U.S. stock market from the peak is -20, but it's 15. We said it was 20%. So we're not out there buying the S&P. In a recession, the S&P will go lower. And the issue is the average drawdown being 23.5. David, why aren't we buying? I don't care about 3.5. Well, because the market was trading at such a premium valuation that you could go down another 10, 20% from here in a recessionary period. But that doesn't mean you can't buy the industrials, which have already been priced into recession. And you can buy preferred stock, you can buy treasury inflation bonds, you can buy US preferreds, and you can collect dividends. And let's remember, when all of this, whether it's tariffed or not, when it all settles out, money has to go somewhere. It's the most important investment comment that I can emphasize. So where's it going to go? If you remember, was it 2023 that GIC rates went up to 6? When it was in a recession, the market got clobbered because interest rates were up at 6, and people just said, "I'm out." The markets have, by the way, kind of eliminated in Canada any rate declines. One of the questions, this is very important that we got, because I think I've answered the other ones in my presentation. One of the questions was, I have a mortgage due, what should I do? Should I go variable? My recommendation is 5 years. And on a 5-year basis, rates are still historically very low and inflation is going up. And they're going up in the United States because we are looking at a whole lot of products. And again, we had the oil price spike is preceding, but the problem is people are going to be out of pocket, not from oil this time, but from everyday goods that they need. That's going to be way higher than before. So it might have the same effect as oil. We will stay tuned, and we'll, again, we're not set in stone. We are not the zombies at TD or Royal that have these 60-40 zombie portfolios. We are going to be proactive. When the facts change, we change. So playbook, treasury inflation bonds, stay with preferreds. One thing we know is that in terms of crisis, the preferreds drop $1, $1.50, but they keep paying their dividends, and that's all we should care about. And if you're somebody that logs in every day, stop. Because all you're doing is you're looking at the bid price and you're looking at a panic price. But panics will subside, and eventually the people will deal with it. So that's the playbook. We've got tremendous opportunities. I've had a lot of emails about let's not do anything. Well, that's not a great strategy. This is where the money is made. We don't have to mark the bell at the bottom, but boy, if you buy some stuff now on a 2 to 3 year basis, you're going to get bargains that won't be around for long. And we're going to buy these bargains with the idea that it's highly possible, if not probable. Look, 17% of the time, we go into recession. This time, the indicators are, it's more like 65% chance. And the longer we go with trade uncertainty, the more a Nike or a Apple is frozen, so there's no capital investment. Capital is not getting into the economy and working and building new plants and equipment. So the longer that goes, the more it's recessionary. And we are not going to buy you something that's going to get killed in a recession. So we know that's highly possible, if not probable. Be careful. Just a side note, I've said, that Canada's reacting on headlines of tariffs, and there's Canadian dollars gone up because of the relief of the not really in the reciprocal tariffs. The big problem in Canada is the housing market and the debt that's coming due. I want to remind everyone that mortgage rates were 5 years ago, they were 1.5-ish. That was COVID, that was lockdown. People in the summertime began to take records amounts of mortgages. This mortgage cliff starts in the summer, and it will then go on for the next 18 months of sub 2% mortgages where people took on way too much debt. You go from a 2% mortgage to a 4% mortgage, you're going to be forking over a lot of money. We haven't seen that since 1991, the rollover. There's going to be bankruptcies and there's going to be foreclosure. The Toronto GTA resale activities for March, we're at a 26-year low. Oh, prices are holding. Okay. We saw that formula in the United States. It's only a matter of time before there's a capitulation and somebody starts hitting some lowball bids, and then you're marking lower prices. 26-year low, and the population of Toronto has probably doubled in that time. I don't know what the stats are, but it's certainly way higher. Vancouver in March hit a 20-year low of resale activity. So be careful. That's not the playbook. Canada's biggest problem is that it ain't tariffs. So again, no GICs, please, from other people above your deposit insurance. Avoid credit unions. They're the most vulnerable. The mortgage investment corps. This is an old chart. Canadian Western is no longer bought by National. And by the way, National stock is down 30%. Why? Bad loans at Canadian Western is my guess. But we shall see in the next earnings reports. That's it, everyone. Thanks for hanging in. Thanks for your support. Our portfolios are holding up way better than the markets. And hopefully we will continue to steer you to get you out of this, but also to position for the unbelievable opportunities that panic brings about. Thanks, everyone. I'll wrap that up. Thanks.